Hello everyone, this is the third part of the lecture for Chapter 1. I'm now on slide 18 of the PowerPoint slides, and please follow along. The last part of the audit is to issue the audit report, and this is arguably probably the most important portion of the audit because this is the way the auditor communicates to those outside. The audit report has historically been criticized somewhat because it is, some would argue, not very informative. It is basically a 3-paragraph letter. There is a standard audit report, and then there's versions of the standard audit report that elaborate on different things that the auditor needs to communicate to the reader. But let's go through basically what an audit report has in it, and then I will talk more about the criticisms about it. So the audit report starts off with a title, and it says that it is the report of an independent CPA. And that is really important. We're going to talk about independence. What we're trying to communicate there as part of the audit report is that the auditor is independent of management. So that's a very critical part of our profession, is that we have to be perceived as being separate from management and have no financial or personal interest in seeing that the client is, that their benefit is tied to our own benefit as CPAs. So we emphasize in the title that we're independent of our client. We address the report typically to the stockholders of the company. They are the owners of the company, and they're the ones that we are reporting to about management's financial statements. Now, a basic audit report has 3 paragraphs: an introductory, scope, and opinion paragraph. And sometimes an extra paragraph is added, which we call an explanatory paragraph. So we will basically just be talking at first about the introductory, scope, and opinion paragraphs, and later in the course we will talk more about additional paragraphs that are added to the report under different circumstances. Finally, the auditor signs the opinion using the firm name, and then they have a date, which is the date that they issue the report. Now, there are basically 3 types of audit reports: unqualified, qualified, and adverse. And there's actually a 4th one that we will talk about later, so I just want to make you aware of that. So let's go through each of these types of reports and what they communicate to the reader of the financial statements. On slide 19 is the most common type of audit report, and that's an unqualified opinion. So an unqualified opinion has also been called a clean opinion, and it means that the auditor does not have to qualify or provide additional explanation about the financial statements. So what this has come to mean is that the financial statements are free of material misstatements, and the auditor does not find it necessary to qualify his opinion about the fairness of the financial statements. Now, sometimes the auditor adds extra language to explain even an unqualified opinion, but basically this means that the financial statements are free of material misstatement. Now, one thing that confuses the public is the auditor is not telling the investor that the company is a good investment. The auditor is communicating that the financial statements are fairly presented in all material respects. And just keep in mind that we're never making an assertion to the readers that it's a good investment. We're not saying it's free of all fraud. All we're saying is fairly stated in all material respects. Okay, so let's go to slide 20, and that talks about the second type of opinion, which is a qualified opinion. And a qualified opinion is issued when there is a misstatement that the auditor considers material. Now, in the conduct of an audit, if the auditor finds problems with financial statements, they'll go to management and try to negotiate how to fix the financial statements. Sometimes management doesn't want to fix it because maybe the financial statements make them look better with certain characteristics. But the auditor, if they feel that the financial statements are misleading, then they have to, under the standards, they would have to issue a qualified opinion. And in that qualified opinion, they would say to the reader why the financial statements are not fairly stated. Now, if you're a publicly traded company in the United States, you have to have an unqualified opinion, meaning your financial statements have to be fairly stated. If your auditor were to issue a qualified opinion, which means that the financial statements are not fairly stated, the rules of the Securities and Exchange Commission require that the stock exchanges cease trading the stock of the company. So companies are under requirements basically to have an unqualified opinion. So the auditor has a lot of power to ensure that the financial statements get done correctly. So just keep that in mind as we go along. Basically, most companies are going to get an unqualified opinion. A qualified opinion happens from time to time, but it's pretty rare because usually if management can fix the problem, they will fix the problem. Then finally, there's an adverse opinion. And this is given when the financial statements are so bad that the error is considered what we call pervasive, that it affects a whole substantial part, many accounts, a large part of the financial statements. And so an adverse opinion basically says that the financial statements are not fairly stated and should not be relied upon. So the qualified and adverse opinions are relatively rare. They're almost non-existent for publicly traded companies, although every once in a while you might see one. But the company probably is on its way out if you see those types of financial statements. So on the last slide, we have some sort of a summary of auditing. But before we go into that, I want to say a little more about the audit reports. What we've covered here in Chapter 1 is really just an overview of what goes on with reporting. The reporting mechanism is much more complex than what we've just described, and in fact, in a couple of weeks we'll be spending an entire chapter on all the different types of audit reports that auditors issue. In addition, on Blackboard I have another mini lecture walking you through an audit report of a publicly traded company. And that is the assignment for week 1, is to go through an audit report and to highlight different sections of the report so that you can see firsthand on your own where these appear. And so I'd like for you to go through the EDGAR system on the Securities and Exchange Commission, find an audit report, and use that for your assignment 1. Now, you can find audit reports through the annual report. There are a number of ways to find them, but you all need to be developing the skill of knowing how to find information about companies, and this is an exercise to assist you to do that on an audit-related topic. So on our slide 22, we sort of summarize Chapter 1, and I want to make a case here that auditing is really an important and thoughtful process. People who are good auditors can make a lot of money. CPA firms, many people start their careers working for them, and they get really good training. So you have to understand more than just accounting concepts and techniques. You have to understand how systems work, how they process information. It is about using your common sense and your intuition about how things work. And it's not just how computer systems work, it's how people work and what might motivate somebody to commit fraud and how might they go about committing that fraud. So getting the skill of an auditor takes some amount of imagination and innovation, and I found it to be an exciting career. I did it for about 6 years. I quit because I didn't want to travel so much. But one thing I loved about it is that I was always being asked to look at new situations, and no 2 days on the job were ever the same. So if that has some appeal to you, I invite you to think about auditing as a career, and we will talk more about the career of auditing as we go through the class.